Hi everyone. It's a pleasure to have you all participating and joining this panel discussion. I think this is the second day of Financial Inclusion Week, and I'm really excited by this discussion that I'll be facilitating today, where we'll be looking at regulatory adaptation and the role of regulators to support innovation in aid of financial inclusion and financial market development. So my name is Jeremy Gray, and I'm a principal at Sendfree. At Sendfree, we are working on identifying opportunities for financial sector development and digital transformation to contribute towards positive societal outcomes and understanding what the implications are for both public and private sector decision makers. So today we're delving into a topic that sits right at the nexus of these two global trends. On the one hand, innovation can create opportunities, enhance efficiencies, increase competition, drive scale, and improve the reach and value of financial products and services to consumers. However, with innovation comes risk. Due to the novel nature of innovation, it's often not fully accommodated within existing regulatory frameworks. And more than that, those risks can often undermine the very value that innovation offers. So, for example, cyber risks or over-indebtedness undermine the value that those innovations offer to consumers. So today we're going to discuss the emerging trends in regulatory responses to innovation, what some of the challenges are that have been faced by different regulators across different jurisdictions, and what are the key and most critical priorities to focus on. So I've got a great panel to discuss this with today and to help me answer some of these questions. So let me start with some introductions. Firstly, we have Nydia Remolina, who is a lawyer with more than 10 years of experience in the financial services industry, law firms, and academic institutions. Currently, Nydia is a research associate at the SMU Center for AI and Data Governance and adjunct faculty at Singapore Management University. Her main areas of work and academic research include financial regulation, capital markets, banking law, fintech, digital ethics, AI governance, and the intersection of law and technology. So Nydia is really one of the experts on aspects related to the regulation of data within the financial sector, and she's been cited internationally in magazines like Forbes, the Harvard Law School Forum on Corporate Governance, Columbia Law School's Blue Sky blog, and a number of others. So really excited to have Nydia on the panel. Secondly, we have Evo Yannick, who I suspect many people may know. Evo has 12 years of experience in finance, primarily in retail financial services regulation. He's led CGAP's work on regulating innovation, particularly on crowdfunding and regulatory sandboxes, looked at capacity building for policymakers, regulation and supervision of digital financial services, and at emerging business models in banking across continents. So it's great to have Eva on the panel, and we'll get into a lot more of the work he's done recently on those topics. And then lastly, Pedro Pinero is a financial regulation specialist with a focus on inclusive insurance. He holds an LLM in regulation from FGV and an LLM in international law from LSE. So definitely well qualified for this panel. He spent 10 years in the Brazilian Insurance Confederation and moved on to also work at the fintech group Stone in order to establish an insurance company under the first Brazilian regulatory sandbox framework. So Pedro has worked both with established providers in the financial sector as well as with fintechs, and working on rules related to open finance in Brazil. So thanks for joining, Pedro. And let me start by coming to you, Nydia. Would you tell us how you've seen the role of financial regulators change over the last 5 to 10 years in response to the rapid speed of innovation and change that we see being driven by digital technologies?
Thank you so much, Jeremy. It's such an honor to be here, and thanks for the kind introduction. Thanks also to Sendfree for organizing the panel discussion and the organizer of the Financial Inclusion Week. We all are very excited of being here, sharing our views on regulation and innovation in the financial services industry. Well, your question is the $1 million question. What has changed in the past decade or in the past couple of years? And what are regulators doing, and how are they responding to this innovation that we are seeing in the financial services industry? Definitely, innovation and certainly technology is nothing new for financial services. But as you said in the question, the pace of those innovation is drastically changing in the last years. Why? Because, for example, we have more data available to work with, and financial institutions are just realizing that they can have other business models and all different products based on, for example, data-driven financial services. And this innovation, this data availability, the mass data production, the penetration of internet of things, all these new and emerging technologies is something that is accelerating the pace of innovation. Regulators have done what they have always done, which is regulating. That is the one of the first strategies that comes when we are talking about fintech and how to face the challenges, risks, and also the benefits of financial technologies in the industry. Regulators put in place new regulatory frameworks that are necessary because they assess and they see that the current regulatory frameworks are not adaptable in all cases to these new ways of doing financial services and financial products. That is the case of crowdfunding and other type of innovations that required in most jurisdictions new regulatory frameworks. Also, the interactive approach is something that is probably one of the newest strategies to face the challenges of innovation and also to learn, because regulators have realized that they probably need to face these new challenges and risks by first understanding what are the implications of innovating in financial services and what the companies are doing, but not only the traditional financial services industry, but also the new competitors and these technology companies waiting and eager to enter in the financial services industry and to provide new type of services to consumers. In order to face the new challenges of these new competitors and the new technologies being implemented by traditional actors in the financial services industry, regulators have implemented interactive strategies such as the Sandbox. I'm sure that Evo has a lot to say about this, given his expertise in the field and his previous research on that. But the Sandbox is not the only interactive approach on implemented by regulators in this regard. Also, innovation offices, accelerators is something that we have not seen before. And actually, other regulators, for example, data protection authorities, are starting to realize that probably to face the challenges of, let's say, artificial intelligence in other industries, they also need to learn from the industry and interact more on a daily basis with them. So we are starting to see data protection authorities to implementing these sandboxes and these type of interactive approaches to innovation. Those could be some of the couple of strategies that financial regulators have implemented so far in terms of how to face the challenges and risks of implementing new technologies and innovating in financial services.
Thanks, Nadia. And I think that point around the interactive approach is really important, right? And increasingly what we're seeing, like if you have a new innovation come across your desk as a regulator, you don't want to immediately put in place regulation when you don't fully understand what the risks are, and you run the risk then of curbing that innovation. On the other hand, you do want to be quite proactive in ensuring that that risk doesn't kind of run right and undermine trust in the market and the stability of the market as a whole. So that role of regulators to be communicators and engage proactively with the market is a major change, particularly, or maybe not particularly, but from, I think, the work that CGAP's done, looking in developing countries, and particularly Evo, that seems quite a big change for regulators to make that shift. How have you seen regulatory authorities, particularly if you're thinking, around aspects that are more core to their responsibilities, financial sector development and like financial inclusion, how have they begun to make that shift to what is a fundamental change in terms of the activities that they are being required to engage with in order to prioritize and deliver on those mandates that they have.
Thanks, you, Jeremy, and also thanks for inviting me. As Nidia mentioned, this is a great honor to be speaking about such an important topic at this platform. Thanks, Sandfree, for organizing this. I'm really humbled by being part of this great panel. So let me just go to your question, maybe underscore what Nidia already mentioned, that this change that we're seeing at the macro level is really multifaceted. It concerns changing the mandate, which kind of keeps expanding for regulators all around the world, going from the sort of the macro and microprudential regulation to covering issues such as consumer protection, financial inclusion, obviously, and now increasingly competition and innovation. This is not always, if at all, matched by expanding resources and capacity. So that's quite difficult. So that's one dimension. The other dimension is the changing scope and scale of activities, which relates to the changing mandate. And then obviously the changes in modus operandi that Nidia talked about when she mentioned the expansion of available data. And also, Jeremy, you mentioned that interaction with the industry that is now a common standard. So there are a lot of these macro changes that we see all around the world, including in our client countries, in lower income countries. But obviously, in detail, they would differ based on the market structure, legal culture, policy objectives, capacity, the nature of the trends. Are they endogenous to the market or exogenous? So all of these things, I think, are happening at some level. And you ask, what is the change in activities that we see with regulators who are responsible for market development and put a lot of emphasis on financial inclusion, for example. So I think that change revolves largely around what you mentioned, the recognition that there has to be a more interaction, not only with the industry, but also with other stakeholders, most importantly, the key beneficiaries of financial services, that is the customers. So the recognition that regulators need to understand better who are the customers that they are ultimately meant to serve, who are the customers who are excluded or underserved by the formal financial sector, why is that, and what can be done about it, and what is the role of the regulator to play in there. And I believe we will talk about it a little later, discussing how to bring customers into the policymaking equation. But at this point, I'd like to mention one other thing, which is prioritization. That's a big task for many regulators who now obviously see all those trends and dynamics in their markets with a lot of opportunities and intertwined risks, as Nidia mentioned, and you as well, Jeremy, in your introduction. And so the key question, I think, for many regulators is how do you prioritize if the resources are scarce and you can't really focus on everything. And so I think one struggle there is how to become an influencer rather than a follower. How do you define for yourself what the priorities are, what are the relevant trends, and focus on those as compared to trying to chase after many things that are emerging. That why should you be the first island to introduce a CBDC as compared to really get the AML CFT that is proportionate right first? So I think that's something that SIGAP is oftentimes seeing and trying to help address. Actually, a few years ago, my colleague Stefan Stashen and his team came up with this concept of 4 basic regulatory enablers for digital financial inclusion. And they're not really fancy. That's why they're called basic, but basic doesn't mean easy, because they require quite hard work to implement them right. And once they're implemented, they can really go a long way in advancing financial inclusion. So I think I should just very quickly mention them, not without getting into the detail, but those 4 enablers, they're not blockchain, they're not artificial intelligence. That might be the next generation, but the basic enablers are risk-based approach to customer due diligence and KYC, consumer protection framework, some framework for e-money issuance, or basically you can say a framework for easy account opening, and a framework for agents distribution, because we know that is very important. My colleague Emilio talked about it yesterday. And so once you get those done, it may be then time for the blockchain and other fancy things. But what I'm trying to say is that the prioritization really, really matters. And even if the change is happening all around the world and is very dynamic and very fast, I think it's very important for the regulators to remain focused, understanding what is the most important thing to do in their own market.
Yeah, thanks, Evo. I think that's fundamental, really good point. And I think what's also increasingly important when you link those two things together that Nidia made around interaction with the market and the key prioritization is how do you also articulate that to the market? It's all well and good to have an overarching consumer protection legislation, but how can you interpret that and guide it to the market? So Pedro, I'm going to jump straight to you. Given that you've worked in the insurance industry in Brazil for 10 years, what would you say are the key priorities from a private sector perspective that you have benefited from or see the industry benefit from actions by the regulator or interventions?
Thank you, Jeremy, for your kind introduction and for the invitation to take part in this exciting high-level panel on the Financial Inclusion Week. To answer your question, I'll be based on what I have noticed in practice, and I think that confirms Nidia's and Evo's thoughts. And what I have seen is that throughout the years, the industry have always led the way in innovation with technology improvements that were then accommodated into the regulation, mostly within the systemic risk or a consumer protection framework. And when I think about the regulatory approach that has been adopted to innovation in the Brazilian insurance industry specifically, I can come up with at least 3 categories that I've seen in practice. The first is very common, and I think it happens everywhere in the world. When you have some one-off obstacles to innovation that have been situated in the realm of legislation. So in respect of which there's little that the regulators can do. And in Brazil, that was the case, for example, of the requirement of a written signature in an insurance proposal. So this was mandated in law, and there was no way out in regulation. And in cases such as this one, there is sometimes an interesting space for regulators to work in partnership with the industry. And through this dialogue with the industry, they can help promoting the modernization, even of the legal framework, to which the industry, both the industry and the regulator, are constrained to. The second, I think, relates to Evo's idea of prioritization, and it happens when the regulator takes the lead in trying to generate a new market segment for very specific public policy purposes. So there's a wider mandate in government to promote one objective, such as financial inclusion or financial education. And this must be incorporated into the market-specific regulations, such as insurance regulation. And I have seen this happen with the microinsurance regulatory framework in Brazil. There was a very strong mandate from government related to financial inclusion. And in instances like this, because the motive is to some extent external to the industry itself, or the priority is not necessarily timely adjusted to the priorities of the industry, the market response was often timid or overlapped with other already established strategies for targeting the same objectives. So the market outcomes in terms of innovation and offer was considered to be lacking of the expectation of the regulator. More recently, however, the insurance regulator has adopted a more manifest intent of promoting innovation, mostly with a drive for competition to the benefit of the consumer. So in order to generate consumer value. This was followed by assertive measures for modernizing the existing regulation, first by segregating mass market regulation from large risks, and then by effectively creating a regulatory sandbox, integrating the insurance industry into the open finance framework, among other measures. And this has given space for a more complex environment, since the modernization of the regulation generated positive externalities for the incumbents, but has also opened the market to new entrants. For reference, the 2 edition of the regulatory sandboxes in Brazil have approved 32 new companies into the insurance market. And the open insurance framework promises to attract even more players from other financial segments into the insurance industry. So in conclusion, I think on your question on what to prioritize, and I would be curious to hear Ivo's and Nidia's thoughts about this, but what we have seen so far in Brazil is that the regulatory drive for competition and consumer value has effectively leveraged innovation in the industry.
Awesome, thanks, Pedro. Let's move on. So I think one of the things that everyone has mentioned, but mentioned really as a tool, is regulatory sandboxes. These are definitely one of the, I would say in inverted commas, new tools that have been developed over the last 5 years to help regulators balance the risks versus the benefits of innovation more deliberately and explicitly. It does seem as though it's dominated the dialogue, particularly in the last, maybe not recently, but certainly initially as they started to develop. There was a big focus on sandboxes as a solution. I think particularly from my perspective in developing countries as the solution. And Evo, as you mentioned, the priorities may not be, in the first instance, the sandbox. It may be things that are more fundamental. So I'm going to come first to you, Evo, because as has been mentioned a few times, you did write the guide on sandboxes for regulators last year, and it is a great paper. And I think one of the things that is really good is around the decision framework and thinking through for whom is a sandbox relevant and what needs to be in place before you should consider sandbox. So would you briefly talk us through what are the key things that you find regulators should first consider before deciding whether or not they need a sandbox, and how they should determine what is sort of most appropriate within their market context?
Thank you, Jeremy. Yes, and thanks, Pedro, for bringing up the competition, because that was definitely a big part of our work and findings. So, Jeremy, very briefly to say at the beginning that my colleague Sean and me, we've come up with the Sandbox decision tree precisely because we wanted to have a more affirmative answer to the question, should I have a sandbox? Instead of saying maybe or depends, we wanted to come up with a framework that gives a clear or as clear as possible answer to that yes no question. And so we had to depart from what we've observed to be a common practice, because sometimes regulators do not go that directly, but there are many consideration issues that they take into account when considering sandbox. The whole political economy, the different priorities that regulators need to address, their constituencies, and so on and so forth. So in a way, the decision tree is the idealized scenario of how one can proceed from that question, should I have a sandbox, to the answer. But we build the decision tree along the 3 steps, which are equivalent to 3 key questions. The first one is, what is the issue you're trying to solve, or what is the challenge you're trying to address, or what is the policy you're trying to advance? So that should help you to define the objective of the sandbox, which is for us really the step number 2, knowing what that sandbox should ultimately serve. And there we saw a different options that regulators typically come up with. One is to learn about the marketplace development and be able to follow the innovation. The second option, very often cited, is to address regulatory barriers to beneficial innovation. And then the third one is to promote competition or innovation. And Pedro basically touched upon all of them. So I'll just very briefly say that not all of them necessarily command to establish a regulatory sandbox, and we can perhaps get to the details later. But then the next question, once you answer what is your main objective, or what is the main challenge or issue you're trying to address, the second question is, what is the underlying cause of that issue? And I think that's pretty critical, because it should not really stop with saying, I want to promote competition or innovation. The regulators should then ask, what is holding the regulation or innovation back? And it well may be that, as Pedro mentioned, it well may be that legislation needs to change. So then what options do you have to address that? And so again, we came up with a sort of a stylized set of answers to that question of what is the underlying cause based on our research. And those are, compliance might be too costly for a number of reasons. Regulation creates uncertainty in the market, or regulation is prohibitive to a specific innovation. And again, depending on what the answer is, the regulator should proceed to a variety of different options. Some of them are actually very traditional rule or policy update or change. Some of them are the newer ones, the innovation facilitators. But not all of them, again, leads to the sandbox. So the third step and the third question is, to solve this issue, is the live testing necessary? So do you need to, in other words, do you need to collect evidence about how the innovation interacts with the live marketplace before you can decide on regulatory response? And if the answer to this question is yes, then we believe regulatory sandbox can live to its full potential, because this is precisely how we see its main utility, helping regulators to collect evidence based on the small-scale test to inform the regulatory response. And that regulatory response, again, can be quite fundamental. It can touch upon many different areas. Again, Pedro mentioned pretty much all of them. So that's how we believe regulators should ideally proceed, asking what is the issue you want to solve, what is the underlying cause, and do you need a live testing to be able to solve that issue?
And Evo, do you think that sandboxes are overused or overhyped as a panacea?
That's an unfair question.
It's a leading question.
No. It's absolutely legitimate question. So my colleagues from the World Bank earlier this year did a research, and they found that there are 70 regulatory sandboxes either operational or in preparation around the world. And that was published, in the first quarter of this year. So I think the number is, again, something much higher. I don't think that if they're overused, but they are very easily misused. If the if it's not clear what is the purpose and how they should be used and what they should serve, then we see that there is really a difference in how they're being implemented. But I want to say something here, in all fairness, that I spoke to many regulators over the years of doing this research, and I realized that even those regulators who implement sandboxes because they want to signal to the market that they are pro-innovative, or because they are negotiating with foreign investors to come to the market and they want to signal to them that the market is open to innovation, or because they have other policy objectives that are driving that initiative, I think those are legitimate objectives. Is the sandbox the best initiative, to put all the necessary resources on? If there are other priorities, that I think we can discuss. So I just wouldn't say that they are overused, but they might be misused. That said, so maybe I should say this. I would assure regulators that if you don't implement the regulatory sandbox because you feel you don't need it, you're probably not risking a big thing. There are still other things that can be implemented, other innovation facilitators, fintech offices, innovation hubs, to promote that conversation with the industry, which is really critical. And then regulatory sandbox, after all, does not make up for a legislative and regulatory change, which often is what is really needed to accommodate for innovation. So maybe let me stop here.
Cool, thanks, Evo. I think that's a really good response. Just a reminder to the audience: you can post questions if you have any. They'll come through to us sort of indirectly, and we can respond to any if we have time as well. But so I think what we've discussed so far is around this challenge that regulators face, the adaptation that they're going through in terms of having to shift their role, increasingly becoming more than traditional policemen in terms of overseeing, telling market players what not to do, and being more proactive, or a word that Nydia used to describe it when I spoke a couple of weeks ago, as an orchestrator for the market, which is a term I really like. So, and I think Sandboxes, other tools, innovation offices, fintech offices, etc., are all tools that help support that. One of the things that's really key that drives fintech, that underlies innovation across the financial sector, I think we can all agree, is data and data governance. And when you combine that with the risks that are increasingly emerging related to data fraud, theft of data, etc., this is really at the heart, or a key central point in the development of financial sector development, the fintech sector, and related topics. And I think will only become more so over time. So I'd like to move on to focus on this on this topic specifically. I think it's the key new risk one of the key new risks that financial sector regulators across the world are grappling with. So Pedro, I'll come to you first, because one of the major developments that we've seen is a move towards implementing open finance. We've seen it across a few different jurisdictions globally. And I think what will be really interesting for the audience is that you were part of the industry discussions in Brazil for open insurance specifically, but broadly under the open finance framework. What did you find to be the most important principles to be agreed on to effectively implement an open finance approach? What were the key prerequisites or building blocks that Brazil needed to get in place to facilitate its adoption? And what do you think it will unlock? If I remember correctly, it's only going to be implemented towards the end of this year, but what do you think the opportunities it will unlock?
Yes. The open banking framework is under implementation. The open insurance framework is being discussed for implementation. And it has been, the open finance discussions in Brazil as a whole have been led by the regulators based on the data protection legislation. And I believe the milestone principle of the whole system is that the client's personal data held by private companies is owned by the client himself, and that it should be shared based in his consent. So I think this is the milestone principle that underpins the whole system, and it comes from legislation. And the open banking framework was launched by the central bank as a regulation of the Data Protection Act applied to the financial sector. And it had an insurance component embedded in it. So the open banking framework encompassed insurance that was sold through banking channels. And this was an interesting indication, and not an unprecedented one, by the central bank, that insurance sold in banking channels is subject to the scope of regulatory oversight of the central bank. But then you would come up with a regulatory asymmetry between products that were sold in banking channels and products that were sold in other channels. And this has triggered action from the insurance regulator itself in drafting an open insurance framework. So the second important principle to be agreed on, I think, was that open insurance would have its specific framework enacted by the insurance regulator, and that it would be integrated with the open banking framework. So at the end, what we expect to have in Brazil is an open finance framework that integrates the open banking framework, the open insurance framework, and maybe the open investment framework as well. Other important aspects to be established related to the scope of the framework in terms of content and participants. What kind of data and which market agents would be integrated, and in what terms, whether mandatory or facultative. The draft regulation of the open insurance provided for the sharing of data, including data generated by what is called embarked devices. So you can have data generated by GPS devices, for example, and that can be shared in the system. And it also provided for the sharing of services. And it integrated insurance companies, so the risk carriers, but it also created a new entity called an insurance service initiator, which is a type of distributor, sort of, while other distributors would not be able to access the rails of open insurance. So the brokers, the agents, the other types of distributors that you might have in the market would not be able to directly access the open insurance framework. In terms of governance, larger insurers are obliged to participate, And there is a specific representation of sandbox insurers. So that was an interesting aspect of it, because since the sandbox was created before the open insurance framework, there was space for these new entrants in the market to participate in the discussions and effectively be represented in the governance, so that they can provide input into the establishment of the system. And of course, these were all contended aspects of the regulation, since it was explicitly aimed at fostering the participation of new entrants who could leverage the open insurance opportunities to explore new business models by accessing clients' data that had been held by incumbent insurance companies for decades, and that was now considered to be owned by the client himself and available for sharing.
Thanks, Pedro. One of the really interesting things I find about the move to open finance or open data more broadly is that in many of the initial countries that have adopted it, it is based on the principle that data is owned by the individual. But that is not something that is consistent across every society in the world, that it comes down to the actual fundamental constitutional rights of whether the individual owns, is sort of the primary individual rights is core to the constitution or not. And I think that differs across different societies, which I think is really interesting, and means that the financial sector, because it seems likely that because of pathway factors, that what is defined within the financial sector will then manifest throughout society more broadly. And so it's interesting that the financial sector is actually creating a norm for a de facto norm across societies. So yeah, an interesting aside that I think is makes this an even more fundamental point than just thinking about financial sector innovation or financial market development. But one of the other interesting things, Nydia, and you're welcome to comment on that point if you've got anything to add, particularly from your part of the world. But unlike in Brazil, one of the things that is really interesting is that in Singapore, the process was much more market-led than regulatory-led. From that experience, do you think that a market-led approach is preferable? And if so, what made it possible in Singapore? And can that be replicated elsewhere?
Thanks, Jeremy. Well, actually, Singapore calls it the organic approach to open finance, which means that it's not necessarily that just the industry decided to put in place marketplaces for open APIs. That definitely happened. But Singapore, in its race to enhance his position as a fintech hub, the Monetary Authority of Singapore decided to, as you mentioned before, orchestrate the implementation of open finance in a non-mandatory way. So they decided to bring together financial institutions, incumbents in particular, and new competitors that were interested in working with the data that traditional financial institutions used to control. And by working together with the entire industry, they decided to just incentivize everyone to join them in this project of open finance, but without a mandatory approach to it. So Singapore doesn't have a regulatory or a rule that is regulating the scheme of open finance. An additional layer to this, and an additional tool that I consider very important in Singapore, that it just shows the policy-oriented and action-oriented policy that they implement when it comes to innovation in financial services, is the initiatives that the government or the public sector launches just to help the orchestration of the market as a whole. For example, in Singapore, we have something called the SG-Findex. SG-Findex is just an infrastructure or a platform, if you want to call it that way, that basically aggregates data that comes from different sources of data, from traditional financial institutions or incumbents and non-traditional actors, and even non-financial companies. And this data serves as, or is held in this platform. This platform serves as the connecting point of everyone that is willing, that wants to work with this data and with data-driven type of services, or to put together this type of dashboards that we see available in markets today for financial planning. These type of initiatives are led by the authority. Something similar happens in Hong Kong, interestingly. Hong Kong, the Monetary Authority of Hong Kong just launched something a couple of months ago, something called a Commercial Data Interchange, which is also a financial infrastructure led by the authority that serves as this platform for open APIs that gathers data from different sources in the financial services industry. And the second layer, or the second stage of this data infrastructure led by the authority, is to put in place a non-traditional way of assessing the credit worthiness based on that data that was gathered in the platform. So they are working, they just launched, they published 1 month ago or so, the white paper for the credit scoring for small and medium enterprises that is going to be based on that data that the Commercial Data Interchange platform is aggregating. So we have these different and very interesting initiatives that are not based on putting together and publishing regulatory frameworks and mandating financial institutions to open their data. That actually works in terms of implementing open finance schemes and enabling and enhancing data sharing in financial services. It doesn't necessarily mean that this will work everywhere. It will depend on the specific circumstances of each jurisdiction. Probably in some jurisdictions, we need to increase competition. That is the main goal and should be the main goal given the market circumstances of that financial regulator in that specific jurisdiction. Probably in those jurisdictions, it is more important to prioritize a mandatory approach to open banking. But in other jurisdictions where you want to just enhance the position as a fintech hub and bring together collaborators that are already willing to share their data and that are already convinced about the potential benefits of open finance, it is easier to implement the non-mandatory approaches to these type of schemes. So it will depend on the circumstances and the specifics of each jurisdiction.
So Nydia, I mean, one of the things that's really challenging with the approach of a non-mandatory approach or non-mandated approach is that financial sector players see data, and particularly the larger players, which are also the holders of the biggest amounts of data, see that as a major competitive advantage, which I think we can all understand, even though it may, I would argue, certainly in developing markets, may sometimes be quite short-sighted because there's room for growth of the entire market. But nevertheless, like, how did Singapore overcome that perception? I mean, as you mentioned, MAS played a key role in orchestrating or catalyzing that discussion. But what were the incentives that changed that view, that changed that paradigm in the market?
Well, I would say reciprocity is a key factor there, because when we started to talk about open banking and open finance from a policy perspective, this was probably when the UK initiated this open banking initiative, and the PSD2 started these conversations about regulating the data aggregators and the initiators of payments and bring more competition, non-traditional competition, to the payments ecosystem. That was the starting point of the discussion of open banking. So perhaps in some jurisdictions and in some marketplaces, there's still this view of open banking as a punishment to the traditional financial institutions, and it's not the case in all markets. In Singapore, what the regulator has done is to bring together different actors that will benefit from a data sharing scheme. Why? Because the consumer is having a better user experience. That would be one point. And secondly, because what I was just mentioning about the reciprocity of the scheme. It doesn't mean an open finance scheme or open banking doesn't mean that the financial institution that is an incumbent is going to have a detriment because they are sharing the data that only they have. Other actors are also joining these platforms and these marketplaces, opening their data through open APIs. For example, the tax authority, some public utility companies and service providers are also joining the scheme to share their data with traditional financial institutions. And actually, you see these places, these jurisdictions and these markets, for example, Singapore in particular, some of the apps that people use as financial planners are coming from the non-traditional sector. So the tech companies and developers that put together an app and offer this type of services to consumers, but also traditional banks are exploring these new revenues and these new business models. And the largest banks in Singapore are offering apps for their clients that are offering this type of services, such as financial planners. Also, they are developing, based on these new data sharing schemes, new models for credit scoring for small and medium enterprises, for example, or they are offering more data-driven services that are based on the transactional data for small and medium enterprises as well. And these are being offered by traditional financial institutions. So they are definitely seeing a benefit from these data sharing schemes.
Thanks, Nadia. Those are, really interesting and important points. And you made a number there, but one that I noted as well is around the point around public sector taking the lead and sharing data as well. I think particularly in developing markets that we often work in, the holders of the biggest amounts of data are obviously frequently the public institutions, the tax authorities, even the regulators or the supervisors, and making that data more available and easy to use for the private sector is often a good starting point. And in fact, in the African context, when you speak to different regulators, for some, or at least certainly to policymakers, I would say, often it's, when you talk about open data, the first thought is around sharing of government data first, public data, before thinking about it in terms of open finance that we're starting to see, like say in Europe, Singapore, and elsewhere. One of the other really interesting dimensions of this is the fact that we're starting to see a lot more examples of regulators working hand in hand with the private sector. And I don't think it's new. Whenever any new regulation comes into effect, there's always stakeholder engagement with the market. Pedro's been part of many of those in Brazil, I'm sure, over the years. But it does seem that with the rapid pace of change, that is becoming increasingly central to the way in which we think about governance. And we started using the word governance rather than regulation often, where to try and talk about the fact that it's around the rules related to the market that doesn't necessarily need to be a regulation or brought about by the regulator. It can be a collaboration between industry and the regulatory authority, because those rules are just as important for protecting industry players as it is for from the perspective of the regulator. So Evo, with that, I'm really interested in some of the work that CGAP is doing at the moment, looking at the role of the consumer in bringing that in. Because what we have seen in different markets is the regulator working with the market to develop new governance frameworks. There's much less of a direct consumer voice into that. They seem to be the third part that's often missing. And it's practically, it's a very challenging thing to bring in that consumer voice. So, how are you thinking about this as CGAP, and sort of what have you learned so far?
Thank you, Jeremy. Allow me just very quickly react on the open banking as well, if I may. Nidia has made a lot of great comments, and she's published this great paper on open banking and how it changes the paradigm in financial services. Another really great paper was published by a colleague of mine, Ariadne, who talks about the governance, and she talks about 12 different design principles or components of open banking regimes. But I want to make the point that, or just underscore the point in the context of Financial Inclusion Week, that it's very important to bring in the data of poor people or people who are low income and excluded and underserved. Otherwise, the open banking or open finance will not do much for them. And it could be the data coming from the government, as you said, Jeremy, or it could be data coming from other providers such as telco, mobile money operators, utility companies, and so on and so forth. So I think that's something worth emphasizing, although it was kind of already mentioned. But when we talk about open banking, open finance regimes in the context of financial inclusion, it's a lot about bringing those other players because traditional banks and incumbents do not hold a lot of data on low-income people, and by definition, no data on people who are excluded from the formal financial sector. And the other quick point I'd like to make is the proportionality. We are heading to the world that is increasingly dependent on data being collected and processed for all sorts of purposes. And there are ways how to make, the society operating, let's say, more efficient and in new ways. But we always should ask the question, is that proportional to what we're potentially losing or risking by disclosing the data? And again, it could be government sharing sensitive data, or providers sharing the data and allowing someone, some provider to gain a monopoly or dominant position in the market when it comes to data control. I wouldn't say ownership. So I think that question of, is that proportional to what we're gaining, is very important and worth asking and coming back to. So now very quickly to the point of question you asked about the consumer participation in policymaking. Yes, my colleague Juan Carlos, actually, Izaguirre, has been working on this topic for quite some time and covering it from different angles. So I'll start with my domain. Regulatory Sandbox can actually help to bring the voices of customers in different ways. For instance, regulator can mandate the innovators testing in the Regulatory Sandbox to actually collect information about how customers interact with innovation, report on complaints, or even provide a summary report at the end of the testing on how that innovation impacts customers and specific segments. Commanding to collect gender disaggregated data, for example, so that regulators understand how that innovation impacts different gender or different customer segments. So that might be one way. But at a broader level, obviously, when there are consumer protection or consumer associations that genuinely represent customers and genuinely fight for their rights, they should be mandatorily part of any consultation process that leads to policymaking, regulatory change, or legislation with impact on the customers. But the point that I would like to focus on a little more is the approach of outcome-based regulation. And that's what my colleagues have been working on recently. And that is the concept where regulator needs to understand how any policy intervention will lead to specific outcomes for the customers. And to be able to do that, you really need to understand who the customers are and how different product, service delivery, or even policy affect them differently or in a similar manners. But the point here is that instead of regulating what is the desired behavior of specific institution or specific providers, you start regulating what is the desired outcome for those specific customer segments. And I think that's where the data availability helps really a lot, the data that Nidia was talking about, because it can improve the understanding of regulators, how those outcomes impact different customer segments. So it's a new approach that I believe helps to bring in the customer perspective very strongly and helps to refocus the attention of regulator and the providers on the outcomes rather than just complying with the rules and trying to tick the boxes and be compliant with the regulation on the activity-based principle. So maybe let me pause here.
Thanks, Evo. One of the specific aspects related to kind of data and related innovation that I know you've done a lot of work on, Nidia, is AI. So just touching on the point that Evo made around, are the benefits of what we're gaining worth what we're losing? What are the key principles that regulators and, in fact, other actors within the governance field should bear in mind when thinking about AI specifically?
Thanks, Jeremy. Well, regulators around the world, data protection regulators, and somehow also financial regulatory authorities and private companies around the world are publishing this guidance of principles called the ethical principles of artificial intelligence. And the data governance discussion has been around these principles. They are transparency, explainability, accountability, having the human in the loop. All those guidance revolve around the same type of principles. However, it is not that easy to translate those principles into practice when we are talking about a specific sector, and even within the specific sector, to translate the principles in what they mean in different use cases of artificial intelligence. That's why I find interesting some approaches from financial regulators. For example, the Monetary Authority of Singapore is trying to do that translation in a specific use cases. So they launched this initiative called the Veritas Initiative, and the Veritas Initiative is a metrics type of initiative. So they are trying to develop some metrics by providing a questionnaire and an outcome-based type of guidance, just to assess the consequences, even the unintended consequences of the use of artificial intelligence in specific use cases in financial services. They are starting with the most sensitive ones, I would say, for example, credit scoring. So they are trying to compare what would happen in a human-based process and an automated decision-making process based on data, and what are the consequences of using artificial intelligence in that context. This to help financial institutions to assess principles such as fairness, which is a very important principle when we're talking about data governance and artificial intelligence governance. Are we discriminating against a specific group within the population by using artificial intelligence? This is common in credit scoring because, as Evo was mentioning before, we don't have enough data to assess the creditworthiness of a group within the population that has been traditionally excluded from financial services, for example. That could mean that if we use artificial intelligence and data-driven or algorithmic credit scoring models, we could be excluding them even more and not allowing them to enter in the financial services. And we would be preventing them from access, for example, to a loan. So these type of measures are something that the Monetary Authority of Singapore is developing in the Veritas Initiative. And this calls back to what Evo was mentioning about the outcome approach and comparing what actually is happening with the implementation of innovation in the industry, and not only talking about the input approach and how to design the model and how to design the algorithm. This is an important conversation as well. It will be more important in some contexts, but in general, data governance and AI governance should be also focusing on the outcome-based approach and what is actually happening when you use artificial intelligence for specific use cases and specific products. The academic literature has been consistent with this. I'm actually working on a paper, but all other people, for example, people from Columbia University, from Harvard, are publishing papers about the consequences of using algorithmic credit scoring. And these papers basically show that the omitted variable bias is something real when you use credit scoring that is based on algorithms. Even if you take this approach, this input approach of eliminating a problematic variable, for example, eliminating the gender from an algorithmic model in credit scoring, that effect is shown in the outcome of the algorithm because of the statistical effect on other variables. So the input approach is not enough. It's not enough saying in the regulation, you have to exclude the gender when you use a credit scoring model. That is not enough when we are talking about artificial intelligence and to assess and actually enforce the fairness principle in AI governance.
Jeremy, do we have 1 more hour to just talk about this issue? Because I think it would definitely be worth it. It's such a fascinating area to untangle. Yeah.
I think it would. I think we need another session to discuss this in detail. But thanks, Didier. I think it's super interesting. The Veritas Initiative is a very interesting initiative, and builds very nicely on what Evo said. I think we literally have like 30 seconds left. So I'm just going to wrap up and say thanks to everyone for participating. I think some of the key takeaways for me is I think we all know that there's a changing mandate and role for financial regulators, particularly as they think about aspects of financial inclusion, competition, etc., and as they deal with innovation, both the opportunities and the risks arising from innovation. I think we've seen a lot of tools be developed in order to help address those, really regulatory sandboxes are one, but they're certainly not the only one that we've seen be implemented and be effective. And I think one of the things really interesting for me, and that's particularly emerging in the data space, is the importance of integrated governance between private sector, regulator, and hopefully increasingly the consumer as well. That we can't just have a regulator-led approach. They're always one step behind the private sector, as Pedro mentioned. Then this last point, I think, around an outcomes-based approach, I think is really important as we start to, as it becomes harder to assess what is the right input, what is the outcome of these new innovations going to be, to rather take an outcomes-based approach as far as possible, although the challenges in implementing that, particularly in scarce capacity, can be quite significant. But I think we're just on the hour, so thank you very much to everyone. As Evo says, it would be great if we had another hour to discuss this. It's super interesting stuff, but thank you all. Thank you, Nydia. Thank you, Pedro. Thank you, Evo. Thank you for your contributions. And I hope that the audience found it as interesting and useful as I did. Yeah, but thanks very much and have a good rest of the day.
Thank you for having us.
Thank you.